I do like to start off each show with, kind of a summary of what I saw happening in the market this week, and it's actually been a pretty eventful week
Mhm.
altogether. There's a
Yeah.
lot going on, and so let me share the chart. So this chart again going back to 2019, I can see that the pandemic, the big run after that, those types of things. So little tail here. This is weekly data. You can see that this week was up,
Yeah, it was a
and
good bounce after the last few weeks.
yeah, we've had quite a few weeks here in a row where the market hasn't done well. Even before that, it was basically going sideways. Of course, this is off of a huge run. If you look at that chart, it still looks pretty good. I mean, that run is still amazing that
Yeah.
happened so far, and having a little drop down like we did is seems quite normal to me. Kind of how things work. And so I just want to zoom in a little bit on the more current data. So this is just the last, couple of months. You can see, that low point there. That was last Friday,
Yeah,
right?
we basically touched that 30 on the
Yeah, right,
RSI.
right above my shoulder there, the RSI, which is this purple line, it hit that kind of low point of 30. That's usually a good bounce point historically, and you could see it was stretched up there, up in that 70 range for quite a while. So again, this is kind of a normal scenario to have this come, and so we'll be looking for some things to happen. For example, like to see this kind of trend line. It's a short trend line, but kind of break through and then obviously get to a new all-time high.
Hmm.
But we have to remember though that in these downturns, right? So here's the downturn from last year. So that top arrow there was the July 31st last year. The bottom was actually during our show on the 27th of October. And you can see there's a couple run-ups there.
Yeah, there's a
Yeah.
couple of bounces back up.
So when we look at what's happening right now, that's why we want to see break trend, get to a new high before you get too excited. There's a couple things that strike me. Usually once you've come down 5%, you're going to come down some more because there's kind of like some damage done to the market,
Hmm.
and that's what happened here last year, right? Yes, you're going to get some run ups, and people get excited. There's something that happens. They're short covering whatever it is. But until you kind of get back all the way, you got to be tempered a little bit on your enthusiasm for where it's going to go. Because normally you'll end up something more like what we had last year with this type of downturn. However, I was thinking back to the second half of 2021 when the market was really strong, somewhat like it is now. And I remember talking about that and saying, hey, we're only down 5%. It's likely we could come down more. And it didn't. It just kept rallying off of that and kept coming up. And so this is, again, a really strong market. So you can see these shorter dips, this 5% type dip
Yeah,
and
going back
recover.
to, World War II, I believe there's about 230 periods that have gone 5% down.
Yep.
And so that averages out to about one every 4 months.
Yeah.
And so it's very common in the market.
Yeah. That's a good point. It's how it works. It's a stock market is a representation of human emotion, in my opinion. And we don't go in a straight line, especially as a group. So
Mhm.
you don't normally see markets go straight up like we have actually had happen, in this last turn. And so now we're finally getting that little downturn. Again, I think this is very healthy. So what's happening this week has a lot to do with a couple of different areas. So first of all, we had the gross domestic product that came out this week. So for the first quarter, 1.6% annualized. Okay. So if you think about it, things are slowing down a little bit. The third quarter of last year was a little over 4% annualized GDP. Then the fourth quarter of last year was, a little over 3%. And now we're at 1.6%. So, things are slowing down a little bit. That's not a bad thing in an inflationary environment. Unfortunately, inflation is actually picking up. We've got
Hmm. Yeah.
the PCE number that came out. We're annualizing at about 3.7% for the first quarter, whereas we were annualizing 2% for the last half of last year.
Yeah.
So inflation's up and GDP's coming down. Um, you get into the neighborhood of what they call stagflation, where theoretically you have no growth and still have high inflation. I wouldn't say 3.7% is high inflation
Yeah.
per se. I mean, in historical standards, it really isn't. But you're kind of in that area that's a little bit interesting. But the biggest thing that's happening, as far as I'm concerned, this week has to do really with the earnings,
Hmm.
because this is earnings season. And so this is a chart. So on the left-hand side there, there's a blue line and the scale for the S&P 500, right?
Hmm.
This goes back 20 years. And on the right-hand side is the scale for the earnings per share for
Yeah.
the S&P 500. So $188 or whatever it is per share is the earnings coming out of the S&P 500 currently. So you can see, first of all, there's a fairly strong correlation between earnings and the stock market. Sometimes earnings are ahead, sometimes the stock market's ahead, but overall, that's pretty important.
Hmm.
But if you look more closely, you can see earnings have kind of flatlined there a little bit
Yeah.
for a while. And we're almost back to where really record earnings per share, which happened back at the end of the 2020 run, the end of 2021 actually. Uh, and so that's why the market's coming up, and maybe the market's a little bit ahead of itself. So we'd like to see earnings growth, and so that's why it's important to look at what's happening. And we're seeing, I think, very good earnings growth,
Yeah.
coming out this quarter. For the most part, again, we look at any individual company, you can see something going on, but if you look at the whole market, it's not too bad. And of course, here's the PE ratio. So this is a fairly important concept where they take the price of the S&P 500, they look at the earnings, and they figure out, what's the ratio. So if you
Mm.
take that last chart, the ratio between the price and the blue line and the orange line is this. And so you can see, this is again the last 20 years. Those gray areas are where there's recessions, and so oftentimes the PE ratio goes skyrocketing high
Yeah.
because the
Earnings drop.
earnings drop so much. And we're at 26 PE, so that's not cheap. You can see that here. It's not really expensive either. I believe the average here is around 22. So, but that's why earnings are important, and continuing to see growth in earnings coming through, I think is going to be important because if you really want that stock market to continue to do well here and not take too many breaks, you're going to have to see, I think, some higher earnings. And luckily, on a projection basis here, you can see, earnings are expected to continue to
Yeah.
grow, right? And so that's good. 12, 13% in theory, the stock market could match that and do that 12, 13% type gains also. So anyway, that's what's happening right now. We've had, great earnings from, Google, and then Google also offered a $70 billion stock buyback, and actually it's called Alphabet now, but and a dividend, their first
Yeah.
dividend ever, right? So the market's up, pretty good today based on that. Was down, the day before, right, yesterday because of what Meta did, after
Hmm. Yeah.
hours, and I don't think the Meta thing's a big deal. I'm not surprised to see that this week's up, even with the Meta, getting sold off. It was off like 12, 15%. Because Meta, they keep talking about the metaverse, and every time they do that, I remember one of the times it dropped 40% after an earnings call
Oh yeah.
in 2022, and so Wall Street gets nervous about that. Are they putting too much resources into something, that is so far out there? So, take that with a grain of salt. But I don't think that's going to affect the market more than it did. Matter of fact, yesterday we saw some buying coming in, even during the downturn that was
Yeah. People
happening.
were trying to get into the dip buy.
Yeah, and so in essence, that's kind of what's happening here altogether. And then kind of the last thing is just because the market's really working itself, hard on when the Fed might be cutting rates, right? I mean, that's a really big one. And there's a kind of an interesting chart here that just shows, kind of going back to 68, how long it was between the last rate hike and then when they finally did a cut.
Yeah.
If you look down there, the average is just a little bit over 8 months. We're right at 9 months now. The last rate increase was the 27th of July. Sorry, 26th of July. And so that's kind of, um, I think that we're probably a ways away from a rate cut. Yes, we're seeing some slowing down of GDP, but we're seeing so many other areas. Consumer spending has been strong. The labor market's good.
Yeah.
Yeah.
If you want, there's still a strong labor market, and the
Yeah.
Fed's happy with that.
Yeah, now labor market does lag, right? Generally speaking, but the Fed has a dual mandate, one of which is to keep the, what they call full employment, which essentially means 4% unemployment or better.
Yeah.
And we're there. I think we're at 3.8. So they're not worried about that. They're not going to cut rates to make full employment.
Yeah, I think it's a record amount of time that we spent under 4% unemployment.
Yeah, and that, it's kind of amazing, actually. And there's still so many open jobs. It's incredible. And I think, and we've seen, and today we saw from the PCE number, PCE is the personal consumption expenditure price index, which is the favored measure of inflation, that most of the inflation came out of services.
Yeah, service. I think it is 0.4% month over month from
Yeah.
services.
And so that's the key right there. It has been for quite a while. We had an inflationary push on goods, during the pandemic when we couldn't do services. We shifted money towards goods. And of course, now, that we can go out and do things, the services are the issue. And that's really labor related for the most part. And with the number of open jobs, that's where inflation's going to continue to be hot. So when I look at, because that to me is it doesn't lag as much, in other words, as it does, say, the unemployment
Yeah.
number. And so when we look at the number of open jobs, and you look at that being so high historically, and it has come down some, which is nice, it just means that it's going to get kind of competitive to get an employee. If you've got somebody at your restaurant that wants to buy food from you, you might pay more. And we talked about that last time you saw at a restaurant, one of the
Yeah.
restaurants paying $26 an hour here local. Why would they do that? Because they need the person.
Yeah, they understand they can make a profit if they get the person in, and
Right.
so they're
Right.
going to pay the extra money.
Yeah, exactly. And even if it's just kind of breaking even for the short term, because you want to keep your customer flow going, right? And have that momentum and stuff is so hard to get. So if people are having to stand in line, they might not come back. And then when things get better and, you get more profit per employee, that person isn't coming back to your restaurant. So sometimes you're better off just kind of keeping things rolling as a business. So labor is a really big piece of this. But, the Fed cutting rates is a big deal because the market has historically done quite well off of those rate cuts
Yeah.
and what have you too. So, you know, it's been a really interesting time frame because we're still seeing some higher inflation, we're seeing some lower GDP. There's a lot of forces crashing into each other. We are seeing a lot of new hires. Every report that we get out, once a month, they come out with that big report for, it's 300,000 plus new hires, which is good. That is going to help the inflation scenario. So overall, I think the market's really kind of in the right spot here. I'm not sure that this downturn's over, but it could be because that's what we saw in the last really strong market in end of 21. There wasn't any particular support that it bounced off of, which would make me feel more confident. Nonetheless, in a very strong market, you can get these types of things. And then certainly in earnings season here, if we get enough upward surprises, or sometimes it's not even the surprises that really drive it, it's what they're saying and what they're projecting going forward.
Yeah,
Right?
and so when it's the major companies too, it kind of brings everyone else up.
Yeah, it's a weird thing. Those calls are kind of funny if anybody's ever listened to them. They're kind of in a tough spot because, if you say that you think things are going to be softer in the future, your stock's probably going to get hammered, but you'll have the advantage of being able to jump over a, lower
Lower barrier.
hurdle,
Yeah.
right? But if you say, hey, we're doing better than expected in the future, the stock's probably going to do well. So if you want the stock to do well right now because it hasn't been doing well, you'd want to say that, but then you do have a bigger hurdle to jump over for that next quarter. So it's kind of fascinating how that works. And generally speaking, the forward guidance is less than, on average, less than what they actually end up doing. And so once in a while you get a company that's just doing so fantastic like NVIDIA, they'll blow away the expectations on forward guidance and then blow that away too, just
Yeah.
because they're just doing so well. But that's not the norm within that grouping. So anyway, that's what happened this week. Again, I still think this market is very healthy. Primary trend is up as far as that goes. And so there's nothing really to worry about here. It's nice to see that this week is positive finally. And maybe we get back to a new high here. I'd like to see us break out of the trend, get back to a new high, and I feel, really good about where we're going as far as that goes. So, again, earnings need to continue to come up, and so it'll be interesting to see what the rest of these reports are like. So, anyway, that's what's happening this week. Thank you for joining for that section, and appreciate it.